Hi, I'm Jim Jubak, and I'm here on Fed Wednesday, September 18th, to talk with Jeremy Hilt, Managing Partner at TF Market Advisors, a credit-focused asset manager, about what the Fed did or didn't do today. I mean, the Fed decided not to taper. You have a sense of why?
Well, Jim, I think the Fed is in confusion mode. And we've been kind of talking to our clients and to a lot of market participants for some time now, and we've all been thinking that today was going to be the start of perhaps a new regime, right? But clearly that's not happened. Now, we might have the start of a new regime, but it's a regime that we weren't all thinking about.
Yeah, the consensus today was that they were going to taper by 10 to 15 billion down to 70 billion. As part of and it was the beginning of the process. What's the new regime?
Well, that's what we're going to find out in the next couple of days. I mean, I think obviously you see the immediate reaction in the commodities market. You see the immediate spike up in the equities market where good news becomes bad news is now good news, but now wait a second, it's back to being good news again. And certainly if you look at what happened to the 10-year, we went from trading in around the 285 today down to I think 272 or so when we closed the market. But whether the Fed has actually done something new, or even perhaps I would suggest that they've done something more confusing, which is confuse us on purpose. Now, Bernanke clearly is a smart academic. He's not out there just jawboning for the sake of making us all confused in the financial media. I think
although he's doing a good job at that.
He's doing a good job, but he might be doing it for a purpose, which is, there's something to be said for kind of Hyman Minsky, kind of preparing the market for something bad in advance. And I think as the market digests this, that might be what they reasonably feel has happened today.
Now, when I was reading through the press release, you always go through and compare it to the last one.
Yeah.
There's some very, very minor tweaks. A word here, a word there. But if you're looking for an addition of a whole sentence, there's only one place where they added two sentences. And that's this kind of strange reference to fiscal dangers.
Well, I think you brought this up today to me, so all the credit to you, actually, Jim. But indeed, when we were speaking to some of our clients in the last couple of weeks, one of the things that we were trying to think about was whether or not people had pre-positioned for the taper. And certainly trading in the last month, even though we had the kind of the August slowdown, managing directors at the beach, kind of the young kids manning the turrets, right? Certainly there was a lower amount of volatility leading up to today's meeting, certainly in the credit markets. And I think that it was largely pre-positioning for tapering. Now, whether we see a spike in volatility or actually something more calming, I think is yet to be seen. My intuition is that, in fact, we're going to see something more calming because we know that the steroids, we know the juice, we know the punch bowl is still there, at least till October anyway. Mm-hmm. Although there was a question, I think, during the presser today whether they could theoretically do something in between FOMC meetings, and I think they could. Whether they would, I think that's very, very unlikely.
Yeah, it was a strange comment from Bernanke. He basically said, well, we can call a press conference anytime we want.
Exactly. But kind of going back to I think the implication of your original question is, well, yes, we've changed a couple numbers, or the Fed has changed a couple numbers in the latest statement here. I would not suggest materially so. I think there's still quite a bit of phantom within those numbers, meaning that I don't actually see how they get from kind of 2013 to where we're projecting out long term, whatever that is.
In terms of GDP growth and in terms of
rates, GDP growth, PCE.
Fed futures rate.
I'm not exactly certain where we're looking at some of the futures markets right now, but based upon where we were in the last couple of days, it looks like the futures markets are on a different page than where some of the Fed projections have been. And as you know, Jim, the Fed has not always been the best projector of economic data, even though ostensibly they have more detail than anybody else.
I mean, right now we're at 0 to 0.25 short term. I mean, the futures market is pricing in what, 1.5,
Well, we were looking at even closer to 2% in 2014 if you were just looking a couple days ago. Now, that actually kind of sold off. I just looked at it before we started this session here, Jim, but it's come in a little bit from that. But still, obviously, the markets are thinking that rates are going to rise faster than the Fed has said they're going to rise today. Now, I think the Fed has to say what they said today. If you can imagine the panic in the market had they come out and said something today about rates rather than just tapering. And in fact, you take it one step back, go back in history 18 months, and the market's made this amazing, well, they've conflated two things that they should have treated totally separately. One is obviously taper, and one is obviously Fed funds rates. And when we talk to traders and we talk to market participants, these two things have kind of been melded together in a way that's really, it should be obvious that they're not the same thing, but the market's not necessarily thought about them in a differentiated manner.
Yeah, and we got, if you look at this, it was like, okay, so we're not going to taper because we're not positive that the economy is on the sustainable growth rate that we wanted.
I really think they, if I could, excuse me for using the term, they got freaked out by the fact we saw all those falling mortgage applications. I think that really hurt. We had something like 9 weeks in a row where quite material decrease in mortgage applications. And I think that could be tied directly to the fact that you saw a real rise in rates. And if you want to talk about how that affects the real economy, the average house price in the U.S. is something in the neighborhood of $256,000. And if you increase your rates from where they were in May, which was about 3.4%, to where they were recently, which was about 4.445%, that's almost a $100, $125 difference per month. That affects the real economy. The Fed's worried about that type of effect.
Thanks, Jeremy. It's Jeremy Hill, Managing Partner at TF Market Advisors. And this is Jim Jubak. Thank you for joining me on Fed Wednesday.